following video is intended for educational and documentational purposes only. All the information in this video has been sourced and/or cited. None of the information, trades, or stocks mentioned in this video are recommendations to trade. Option trading is extremely risky. Please consult a financial advisor before trading, and trades made from this video may result in financial losses. So do not trade anything shown in this video. Thank you. Ladies and gentlemen, welcome to our first edition of Slumdog Trading Educational, Session 1. My name is Jovan. I will be your host this evening, and we are going to go through my personal, I guess you could say my personal stock Bible that I follow. And basically this is a video of all the information that I've saved, that I stashed away, tips, tricks, facts, you name it, definitions of words, terminology, everything that I have learned in the past 5+ years of trading are all going to be broken down into these videos, and I'm going to show you exactly what I do on a daily basis now to trade as a side hustle. Now, you may be this is honestly and truthfully, I'm going to get this out of the way. This is mainly for the individuals that work a 9 to 5 or even more. They don't have no days off. They're constantly grinding. They're working 60+ hours. They're working retail, they're working back offices, they're working just dead end jobs and just still can't afford to pay the bills right now. This will be your side hustle. This is your extra bread and butter that you can do literally just sitting on your ass. Literally sitting on your ass on your phone like you're doing right now. Watching YouTube videos on Facebook, on Instagram, seeing what else everybody else is doing, taking Snapchat pictures, using filters, going on Amazon.com, trying to buy the next thing. Instead of doing all that, you could be looking at option plays. You could be sitting there turning $200 into $10,000. You can be doing that on a daily basis. And this is what I'm here to teach you guys, or to show you. So, let us not delay. Let's get right into it. So this is a little breakdown of what we're going to be covering throughout the next, I can't really say, there's going to be a lot of videos, let's just say that. But here's a breakdown of everything that we are going to cover. So let us not delay. Once again, we're going to jump right into this. What are stocks and shares exactly? And yes, I am trying to give you $1 million worth of game for $9.99 here. If you notice, we're not charging anything for this video. We're not sitting here, hey, you guys want to learn how to turn $500 into $10 million? And charging you like on a monthly basis. And you're sitting here losing money and not getting any type of information as to what the hell's going on. So that's why we're breaking it down to the basics of basics here. What are stocks and shares? Stocks and shares. So a stock is a security that indicates ownership of an underlying company's assets and earnings through shares of a company. Or in layman's terms, I own you. I own a piece of you. So the more shares an individual owns in a company, the more one gains and can potentially gain if the stock is held for some time. In other words, the longer you hold that stock, the longer or the more opportunity you have for that stock going up, more profits. Now, there are different types of stocks. For example, an ETF. It's a fund that trades like a stock, but is made up of assets like real estate or other stocks, futures like oil, commodities, precious metals, but essentially every ETF is different. Though some may hold the same asset or stock as another ETF, with little differences such as dividend payouts or the exposure to an asset, some may even move the same way. Like, for example, the SPY and the SPHD. And we'll get into that in the next slide here. But some companies may provide what is called a dividend, and on a quarterly basis for holding on to an underlying stock. So it's basically a payment for holding on to the stock for some time before the payment date of the dividend. And the payout is based on the dividend percentage, the amount of shares an investor is holding, and the price of the stock at the time of payment. For example, ETFs or the exchange traded funds generally have a dividend payout. An example of these are the SPY, MJ, Gamer. All ETFs generally have a dividend. Now, you're probably like, oh, already you're probably like, what the hell is all this? This is way too much information. I'm giving you the breakdown of what everything is. I'm giving you what the layman's terms are, but I'm going to explain to you in the basics of what all this means. So stay with me. So an ETF, so this is what I was explaining earlier of the SPY and the SPHD. You see on the graph on the right how they are mirroring each other. What is the one thing that you know is different between the two? If you guessed the price, you are correct. The SPY is worth $281.59, whereas SPHD is $31.54. Now you're probably like, why the hell is that? That is because one came out before the other. However, they are invested in the same exact thing. The only difference is one is exposed to other things more than the other, which causes that stock. That's why they follow the same exact pattern there. Same exact pattern. So, for an early investor, SPHD will be a great choice. Now, none of this is a recommendation. However, SPHD is a great dividend stock to have for early investors. Now, let's continue. ETFs. So sometimes an ETF may mirror, like we were explaining, another ETF in trading. This can mean that one may have more holdings of an underlying asset that can hold other or some other desirable trait. That trait can often be a great opportunity for new investors who want to have a little exposure to a certain ETF but does not want to pay more, as we explained earlier. So now, in short, ETFs are good for long-term investors who want to hold on to stocks for many years while at the same time receive a payout every quarter. So that's every 3 fiscal months. Yeah, so basically, bottom line, if you're looking to save money and have money when you retire, invest little by little into ETFs. Research, find what ETFs look viable, like MJ, as we mentioned earlier, GAMR, Gamer, which is part of the gaming field, and they have a whole bunch of filings for different gaming companies like Activision, Nintendo, Sony, you name it. But key thing is you have to do your research and make sure that it is something that you want to invest into for longer than short term, like longer than 5 years. This is something that you want to retire on or pass on to your children, basically. All right, moving on. Stocks with dividends. Yes, my personal favorite. So a stock does not have to be an ETF to provide a dividend. In fact, big companies like AT&T have consistently provided a dividend for their investors even when their company may not be doing good. So this provides good faith in the company among investors. Since the company is paying you to stay, why not? Only if the price is right, of course. So not every company provides a dividend. So sometimes even a dividend may even be what is called a dividend trap, which we'll explain much, much later. But there's a general rule. As you can see on the right, I took a picture of AT&T's dividend, which is at 7%. So roughly that means that there's a calculator to calculate how much that is too, but it's the dividend is the percentage based off of the price of the stock and how many shares of the stock that you own. All right, and then also some trading platforms even allow you to do what is called a DRIP, which is the dividend reimbursement. It basically it's the automatic reimbursement of the dividend into the stock itself. So they calculate the dividend payout for you and they reinvest the dividend back into the stock for fractional shares or whole shares. And that's all depending on the amount of the payout. And yes, of course, Robinhood has this feature, which you can enable on your phone. Now, remember, the more shares you own, the higher the stock price, the more a dividend will pay out, which is varying on the dividend yield. Now, this actually changed as well. Just FYI for AT&T, they recently cut their dividend yield because of the coronavirus and everything that's going on. So, just that little heads up in case you were looking into trying to invest in that, weigh out your options. Now, we're going to move on to my favorite and absolutely best way of making money. What are stock options? As the great Robert Allen said, how many millionaires do you know who have become wealthy by investing in savings accounts? I rest my case. There's no one in this world who's become a millionaire by investing into savings accounts. Millionaires are made with stock options or holding on to stocks for a crap load of time, like decades. All right, so let's get right into it. Ladies and gentlemen, welcome back. So now we're going to jump right into it. My favorite part here in this video, we're explaining what are stock options. So as first, I'd like to say what my boy Robert Allen said at one point in time. How many millionaires do you know who have become wealthy by investing in savings accounts? I rest my case. The reason why I put that on there is because the same exact thing that I say about stock options. I do not know any millionaires. I don't know anybody that's been making a lot of money just having their money just sitting in the savings account. Your money is not working for you right now. If you're unaware, the Feds have cut interest rates, meaning your savings accounts are clapped. They're wrecked. They're not collecting anything. Your money is just sitting there collecting dust, essentially. So what the hell are you doing? Put your money into stocks and stock options, please. Please, if you're watching this video, there's a reason why you're watching this video. You must be trying to find something to do with your money. And I don't blame you, because I was in your position at one point and I got tired of it. And here I am. Now I'm making a video to explain exactly what I've been doing for the past 5+ years. So let's move on to it, ladies and gentlemen. So stock options. So stock options are like what I like to call coupons. They give the individual the right, but not the obligation, to buy a contract of 100 shares of a stock at a specific price, which is called the strike price, and by a specific date, which is called the expiration date, that the individual chooses. So both are vital for an investor to determine how to position themselves for the most gains and calculate the amount of risk that they may take on the underlying stock. So what that means is 2 of the 4 big bolded words, as you can see here, are highly vital. It's the strike price and the expiration date of any contract. Position, it's definitely a vital thing, but the most important is the strike price and the expiration. Because if you have time, and this is something that I tell everyone that I talk to, and when they're buying any type of stock options, buy time. The expiration date is what is highly important, and also the strike price, but time is money. Time is everything. But we'll get more into that later. I'm getting ahead of myself. I apologize. So when it comes to stock options, there are 2 types. There are call options and put options. Call options, which I highlighted in green to signify, are used when they're going up, when the stock is going up. Put options are used when you believe that the stock is going down. Now, put options are also what I like to call insurance. They protect a play or a stock when it's going down. So you're never losing money. If a stock is going down, you can get money back. So it's good. Sometimes it's good to have a mixture of call options and put options to balance it out. But we'll get into balancing out your plays. We'll get into all that good juicy stuff later. This is video specifically about breaking down the basics, and I want you to understand the fundamentals first before we get into the pool. Now, if you have Robinhood, of course, if you started this video and you believe that we're going to be using TD Ameritrade or anything else, no. This is specifically Robinhood and Robinhood only. The reason being is because I feel as though it's more versatile when it comes to mobile use. However, of course, I do know that the web-based version isn't so good, but this is great because of the fact that, like I explained earlier, this is for those people that are working 9 to 5s that don't have time to sit there at the computer looking at charts all day. Like, you can just look on your phone, look for a play, and play it. So in Robinhood, this is what you'll see. Call option, believe the stock is going up. Put option, believe the stock is going down. That's simple. Now contracts. This is when we're going to get a little bit more in depth here. This is when things are going to get a little tricky. So contracts. Contracts are the number of option plays, as I like to call them, a trader may be looking to buy. So one contract is equal to 100 shares of the underlying stock For example, if you buy one contract of Apple with a strike price of $500, expiring on January 15th, 2021, you are saying if Apple hits $500 or above on or before that date, you will buy 100 shares of Apple at the $500 strike price. And anything, let's say, for example, if Apple goes above $500, you will get in profit. Now, on the right, you will see one Apple $500 call contract. This is a call that I picked out. Cost $93. Now you're wondering, why does it say 93 cents? It's 93 cents multiplied by 100 shares, which equals one contract. Now this one expires, like the example, January 15th, 2021. If this does not hit, this meaning the Apple stock, $500 by that date, it will expire worthless. And you will lose $93. Good day. Good day to you, is what Robin Hood would say. You will lose all that. Now you're probably wondering, why will I lose that money? Well, did the stock hit $500? Did it fulfill its obligation? No. Shouldn't I get that money back? Of course not. No, it's worthless. Like, no one is going to buy that contract from you. Or in this case, this coupon. That's like saying, hey, I got a Macy's coupon that expired, like what? That same day. But it's only for $5 off of a specific item in the store. Like a cup or something. It's worthless. It doesn't have any value whatsoever. Okay, bad analogy, but still, it's worthless. Essentially, just know that if you want to sell a contract before it hits the expiration date, the only time that you want to wait until the expiration date is if you are in fact wanting to buy that particular stock. In that case, you get the stock at the discount and you collect a premium on it. But if not, like I do, sell them before the expiration. Now, depending on the actual company itself, we'll get into all those details later, but depending on the company itself will determine when you want to sell that particular contract. Timing is also key as well. Now, let's continue. Let's jump back into it here. So as I mentioned earlier, you are not obligated to stay in the contract until expiration. You can sell before and collect your gains, if any, which is called the premium. However, if you do stay in your contract and your in the Apple contract itself, for example, did not hit $500 strike price by January 15th, as we mentioned earlier, let's say it hit $490, it'll still be worthless. If it's $499.99 by 4 p.m. on the contract date, the expiration date, it's worthless. If it has premium, you might be able to collect on that. But you will see it will go to, when it says worthless, meaning it will change to 1 cent. 1 cent. No one is going to buy that. No one's going to buy that. Now, you might hear the term in the money. That's meaning that the contract is basically ending the strike price. So now if you don't sell it when it's in the money, sometimes the system will automatically exercise you into those stocks. So you want to make sure you stay on top of that. Key thing to remember, especially Robin Hood. Robin Hood would definitely do that to you. It happened to me one time, but never again. All right. So the strike price. So according to Investopedia.com, the strike price determines whether an option should be exercised. It is the price that a trader expects the stock to move to be above or below the expiration date. Now, this is where most people lose the most money. It's also the second key component for being successful at option trading. Now, finding a strike price for a stock can be difficult. However, it can be easy once you understand what you're looking for. Because strike prices can also determine how much risk you're going to take. For example, Costco on the left here. We have we have 25 of those for 50. The strike price is at 50. And we bought them at 21 cents, which is $21 per contract, and expires on January 17th. So currently the price of the Costco stock when we bought this was at like $40, but it rose at the end of the day to $43. So because it's roughly about $8 away from the $50 strike price, if Costco continues to move up, the contract will hit the strike price with a high value, meaning in the money. And also, because they're so cheap, there's a low risk to losing out. We only paid $21 for them. So there's really no risk at all. So even if one or two contracts are bought, this will still be a potential returning of $100 or more if it's in the money. And that's a $79 come up right there. Easy money. Easy money. So worst come to worst, if it doesn't hit the strike price by July 17th for $50, you just lose $25. Simple. Like people are like, wait, it's just $25. That's $25 in my pocket. I get that. But again, what did I say earlier? Time. Time is key. It's only May. This expires in July. We have 2 months on this. Time will help you in every situation when it comes to a contract, especially when the strike prices are far away from the money. And what I mean by far away from the money, meaning if you have a strike contract, or if you have a contract that's the strike price is at $100 and the price of the stock currently is at like $40, and the expiration date is May 20th, 10 days from now, that's going to be worthless. There's no time on that. There's going to be completely worthless. Unless you're Tesla. That's the only exception to the rule, because some companies, some stocks are volatile like that. They move up and down crazy. And sometimes you can get lucky. But you can also lose big. So that's why I always tell people, start small, work your way in, scale in. Now, the expiration date. So, again, according to Investopedia, options do not only allow a trader to bet on a stock rising or falling, but also enable the trader to choose a specific date when they expect the stock to rise or fall by. This is known as the expiration date. The expiration date is important because it helps traders to price the value of the put and the call, which is known as the time value. And that's what we were talking about earlier. Time equals money. I even put it in green and bold there for you. Time equals money. Always remember that. Time equals money. Time equals money. Get it? So this is the other major component when we were talking about option plays. So contracts that are closer to expiring, that have not hit the strike price or are nowhere near it, out of the money, will lose value. For example, got clacked on these Roku plays. The Roku play for $180 strike, it will lose more value over time the closer it gets to the June 19th if Roku does not start to move up before then. And I believe currently Roku was trading at like 127, 126. They had a bad earnings report. Actually, they had a decent earnings report, but they still dropped, I believe, because of ads or something like that. And again, getting ahead of myself. I'm talking about research and all that later. But yes, this only has June, so it's not that much time. It's only a month. So if it does not start to move up before then, this is going to lose a lot of money. As you can see here, this was bought at $300.20 a piece. Bought 3 of them at $320 a piece. Now they're worth $138 a piece, which is $414. We lost $546 on this play. Again, I don't think I mentioned this, but if you're going into stock option trading, prepare to lose. You must go into a mindset that you are going to lose. You're going to lose money, and you cannot be afraid of that. Because guess what? When you fall, you will get right back up. Because if you fall and you stay down there, that's on you. I hate to say it, that is on you. Because the stock market is not designed to fail. There's plenty of ways to make money here. Now you might be saying to yourself, well, I just blew all my bill money. You didn't start small. You did not start small. Now, again, if you haven't noticed, I have a tendency of getting ahead of myself. My mind goes from 0 to 90 in less than 2.5 seconds. We like to jump ahead. But I will explain budgeting and staying within the budgeting, not getting the FOMO, rebuking those FOMO demons, and staying in the game and starting small. We'll explain all that later. But I just want you to remember this from the beginning. Start small, invest in time, and do not give up. Just keep your head in the game. If you see your stock going down, if you have time, don't worry about it. There have been multiple times that has happened to me in trading in the past 5 years that I have kicked myself so hard. I'm talking birthdays. I'm talking like not birthdays, but money that could have been used for other things. I could have been used in investing. I could have basically used that money for investing. I'd rather have lost it in investing, let's say that. But we're here now. God is good. He has given us this blessing. And you guys are learning. You guys are here for a reason. You guys are here to learn exactly what's going on. So, let me stop Bojin Chandoaki. Let's continue. So, how much should I invest? As the great Warren Buffett, and something that I live and die by. Be fearful when those are greedy, and be greedy when those are fearful. Those are words to live and die by, ladies and gentlemen. Seriously. When you see people pouring out of things, and it doesn't make sense, be greedy. If you see people pouring into something because they believe in it, it's such a great opportunity. Virgin Galactic Virgin Richard Branson sold $1 billion. Be fearful. Budgeting. So, with anything financial in life, you always want to live within your means. Also a motto that I live and die by. In other words, if you can't afford that new iPhone 25 XXP that costs $2,000 and you have rent due the same day, you probably should pay your rent. I think that's more important. So the same concept applies to investing. If your option play is up 1,000% and you have a ridiculous amount of gains, don't sell it and then you put it back into another option play. Be smart. Budget it out. Also, same applies for your paycheck. If you feel as though that you're going to be missing out on an opportunity on getting a whole bunch of money on Tesla, don't put all of your paycheck into it. Let's be smart. Start small. Ease your way into it. If you have $1,000, feed yourself $1,000, like $100 here every 2 weeks, but put it in a separate account and feed yourself that bread. Don't put it all in one play and then end up losing it all. It's too risky. I'm risky. As you can see here, this is a copy of my profile percentages here. I am a risky investor. However, as you can see, I have 26% in long-term stocks, ETFs and stocks. But 74% of my plays, or my profile, is option plays. And that's because I am a risky investor. I am very risky, but I have not lost any money that I put into this at all. The money that I've lost is money that I have gained in the stock market, because all I'm doing is following this little method right here that I'm about to show you guys. Simply started out with, I think in my case it was like 1,700, but nonetheless. So rule of thumb basically for new investors would be like 700 to 1,000 as an initial investment. And that can be mixed into stocks and stock options. Now the minimum, once again, it can be anything you want, but I would say the minimum would be $100 a month to trade. That's it. $100 a month. A hundo piece. That's it. That's $50 every 2 weeks. That's it. I cannot stress that enough. Some people are like, yeah, they be like, hey, wait, that $100 can go somewhere else. No, it can't. What are you going to spend that on? I guarantee you buy other things that you do not need for $100. That $100 can be working, and it can be working very hard for you. That's all I'm going to say. Now, how that's mixed as far as your portfolio, it's completely up to you. Then, as I mentioned, some are crazy risk takers like me, others are more cautious. But for those who are just starting out, I will follow this method until you are comfortable with trading. Then you just adjust it accordingly. So 60% in long-term stocks, and that's with like dividend. So that 60% long-term stocks, that dividend growth, the drip reinvestment that you can activate in Robinhood. 40% of it will be in option trades, which you can flip for fun. And so that would equal out to about between $420 to $600 in stocks, or $280 to $400 in option plays to start. And that's with the between $700 and $1,000 investment, initial investment, excuse me. So that money can be from your stimulus check, which, I mean, hey, some of us may have blown over through it, or tax returns, or savings, or just 2 paychecks. $350 here, $350 there. Set it aside. Or, at the very, very minimum, if you really, really scraping at the bottom of the barrel, $100 a month. $100 a month until you have some type of lump sum that you can throw in there. $100 a month. That's it. You can even break it to 60-40. Get 60% in stocks and then 40% in the option trades. You can make an option trade for $40, believe it or not. And we will show you. We will show you. But you also have to be independently doing your work as well, which is going to lead us to our next slide. Research. Now, it should go without saying, always research a company before you decide to jump into a stock or option play. Now, sometimes you might hear someone talking about how great a stock is. The next thing you know, you're out $750 because you didn't do your own research. Never, ever, ever trust anyone's word without verifying it first. Me included. If you're sitting here watching this video because you want to learn about stocks and how to make option plays, verify this info that I'm providing you. I challenge you to do it. In fact, I'm providing you with the links to do so at the bottom of the video. As you can see, we have all the videos, there are links there from Investopedia. I cite everything. All the information I get from Robinhood, Investopedia, NASDAQ, cited. Never trust anyone, because you never know. You never know. Now, going back into research, it's always good to have financial news outlets, like news outlet feeds on your phone, available to you, so that way you can keep yourself in the loop about any negative or positive catalyst that may drive the stock up or down. So, for example, I'm glad this happened because this is perfect for this video. So, Elon Musk made Tesla's stock drop with simply tweeting out, Tesla's stock price is too high in my opinion. And that just drove the stock price ridiculously downward, yes. People were selling off. They were like, oh, Elon says he thinks the stock is a little too high. A word? Oh, my bear. And they started selling off. So me being me, I'm like, this may be a perfect time for me to jump in, because I just made a couple of plays off of Chewy, made a couple of plays off of who else? I think Activision at that time too. And I was like, you know what? Me personally, I'm scared of Tesla. I had bad dreams about Tesla. Anyway, long story short, I decided, you know what? It looks cheap enough. So I got those 2 plays on the right, and actually 4 plays. So I got 3 contracts that had a $950 strike price for $231, and one for $1,100. Now at this time, I think the price of the stock went down to like $650, maybe 7. No, I'm sorry, it's probably like 7 something. It was like 7 something. And next thing you know, this was on Friday, Monday, it shot right back up. Why? Because the news that said that the company was looking to provide electricity for part of the United Kingdom. So this is case in point of why you always want to do your research and scan the news for any bit of info on a stock that you have in question. Because it can change in a matter of seconds. Seconds. Always do your research. And also stay in the loop. Because that's something that I also had to learn very, very quickly. If you're not in the loop, meaning if you're not on Twitter, if you're not subscribed to anything, you don't get news notification of what's going on around you, you're just the reality TV hog and just feed into that, then maybe stock trading may not be for you. I'm sorry to say. You want to be kept in the loop of the news around you. Not saying to feed into the news, but I'm saying you want to be informed. If you're not informed, you will lose money. All right? Now, a lot of you have been asking me, when is a good time to buy and sell? Correct answer is, there is none. Some people may say, that's stupid, Javon. You don't know what the hell you're talking about. Well, that's fine. Again, you don't have to take my word from it. But in my opinion, there is no perfect time to buy or to sell. Perfect time to me is anytime. Anytime that is within this range here. If I can get my closer, this right here. This is the one. This is what I always look at in a stock. What has happened in the past 52 weeks with this stock? What was the highest point? What drove it to that point? How can we get back to that point? Is the company on the verge of going to that point? These are the questions that I ask myself before I make these types of plays. Reason being, if you get lost in the sauce, as I like to say, of trying to figure out when to buy and when to sell, you're never going to figure it out. You're always going to either be losing a lot of money, or you're going to be gaining a lot of money and then losing that said very money, and you're just going to be canceling each other. You're going to cancel yourself out. Because especially right now, with the stock market being so volatile, it's impossible to determine. So among all the toughest challenges in trading stocks and options, knowing when to buy and sell a stock is by far the most difficult to master. However, if one is trained on looking at charts, technical analysis data, then you should be generally okay. And like I said, personally, I also read investors' emotions. So if news broke out that a company made a true vaccine for the coronavirus, investors will find that company and dump as much money as they could into that, naturally. However, the amount of profit that investor receives depends on when and on what point did that investor buy in, which leads us into what I was explaining earlier. This is that key point for me. This is what I use. By looking at a stock's statistics, and this is again from Robinhood, combined with reading how investors will react to news, finding a buying selling point can be easy. For example, Costco, pictured here, was trading at $58.26 52 weeks ago, as we showed you. It is now trading at roughly $42.58. So now, assuming we researched Cisco, which I did, we know they are a company that provides call centers, banks, offices. They all use Cisco network systems, and because most of them are considered essential workers, such as myself, working from home, this creates an opportunity for Cisco to capitalize, which is true. It makes logical sense. A network company that would gain from so many businesses having to resort from working from home remotely. In short, it means that Costco has a great mock look in the future of hitting that 52-week mark again, or more. And if you're following along, can still hear, that means that Costco is a buy right now for either short or long term. And again, this is not a recommendation. Please do not trade this. As mentioned before, if you're up a decent amount, say 50% or more in an option play or a stock, and you see your gains start slipping away fast, I would think you would want to sell immediately, to be honest. If not, then is it really worth it? You gotta ask yourself that. So stocks themselves are different. If you buy a stock, you can have the intention of holding that stock. You should, have the intention of holding that stock for a very long time, depending on its quality. Like if you're buying and selling ACB, please, please stop. Those of you listening, I know who you are. Please just stop. Don't do that. ACB, if you don't know, is a cannabis stock. Don't. No, please. No, don't do that. ACB is bad. All right, moving on here. So, earnings. Earnings season, which is now, ladies and gentlemen. It's 4 times in a year where investors can become legends or fall into darkness and never trade again. This is the time of year when companies report the health of their company in relation to outside circumstances, their balances, revenue, product line, services, lawsuits, operating costs, all that jazz. All the gears that work the mechanics of the company, basically. This is when a company can report that they did very well, okay, or horrible. And however, the key is figuring out how much a company's stock might move up or down with those parts of the company in mind. This is where figuring out how to position yourself comes into play. There are a lot of trading techniques. Some I will cover in upcoming sessions that can help maximize your gains, and some can also minimize your risk. And those are essentially the essentials to surviving the unknowns of earnings plays. Now, sometimes they might be straightforward, sometimes they might be questionable. So keep in mind as well, quarterly earnings reports are done for the 3 months before the date of the report. For example, May 15th is when Costco reports for the months of February through April. And lastly, sometimes you'll find that companies may report good, though their company drops the same day or the very next day. That is due in part to investors taking profits, and sometimes companies may change what is called guidance. It's where a company gives an outline to investors on where their company is heading in the coming months. So what's revenue going to look like, for example? If a company does do great, but the guidance is horrible, you can expect this stock to drop, and vice versa. So if a company reports horribly, yet has an excellent guidance to profitability for the rest of the year, expect the stock to jump up. For example of that would be PayPal, which we pictured here. They had a horrible earnings this first quarter for 2020. Yeah, it was on May 8th, and because of the pandemic and everything that was going on, of course, at first they were taking a hit. They seemed like they were going to do good, but the reason being is because small businesses, of course, and PayPal provides help for small businesses through transactions, merchants, and all that good stuff. They were providing loans for them, and they relied heavily on the government and the PPP loans and all that good stuff. And it drew on them. It drew from their coffers. So this in turn caused more debt for them. But they did say, however, that they saw an increase in sales in the beginning of May, which is their best day in years. So because of the fact that their quarter fell between February and April, their stock went up instead of down. Normally, if they did not guide and if they didn't have that best day in May, which was everybody coming, because of the lockdowns being a little bit eased in different states and internationally, it started looking good and everything like that. The stock started to go up instead of going down. Normally, that should have went down, but it didn't. So they said, I believe, that they saw an increase in the beginning of May, and that was the best day. Sorry, kidding. The news. So I might want to edit this part out. All right. So that is it for earnings. I have nothing else for earnings. Let's continue. All right. So next topic here. This is just going to be a super simple, basic overview of what Robinhood looks like. As my boy Ben Graham said, the individual investor should act consistently as an investor, not as a speculator. So what that means is you should probably use Robinhood and play with it. Go to town with it. Just get lost in it. That's how we learn. That's how most of us learn. Visual learners. Like, make mistakes. That's how you learn from them. That's what I've learned these past 5+ years. I've made a lot of mistakes on Robinhood, but I've learned from them and I've grew from them. And that's why I'm teaching you. So this is how you buy a stock on Robinhood. Now, many of you are probably like, oh, Javon, this is way too simple, but a lot of people don't know how to do this. So first thing first, if you're in Robinhood, you want to find the magnifying glass, which you can see here at the very bottom, and type in the stock that you want to see. In this case, we use Twilio, stock symbol TWLO. And on the bottom right-hand corner, there's a little button here that says trade, and it turns into this. Trade options, buy. So if you want to buy a stock, you click buy, and it'll take you to this page here. And this shows you buying Twilio, and this is how much you have available, number of shares that you want, how much the price of the stock that's currently at, how much it's going to cost you. Click and done. Congratulations, ladies and gentlemen. You just bought yourself a stock on Robinhood. All right, moving on. Now, buying a call option on Robinhood is a lot different than buying a stock. So we're going to that same page that we were in the stock itself. However, you saw the option when it says trade options. Now, some of you may actually not have that available to you. So you may actually want to go into your settings and actually turn it on. Rule of thumb, though, you may want to be a little bit. How can I put this? Basically, you want to say you want to have experience in trading. You want to have that experience in making trade option plays. Otherwise, you're gonna have the basic version of trading options. You're not gonna be able to do like spreads and anything like that until you have experience on Robinhood. So, getting back into it here. So buying a call. So in that same page, this is what it looks like on Robinhood here. This is the option chain. This is what everything looks like in their pricing. So as you can see here, the higher you go up on the call side, the cheaper the options get. But the strike price, if you haven't guessed it, is higher. Meaning, if the stock doesn't hit it by that particular time and that price of the contract is expensive, you can lose that. But again, up here is the time. You want to buy time. You want to be on as much time as possible that you can afford. All right. So once you select your play here, I think we picked a 180, just this one for 723. It would look like this. Now this screen, this is also another huge difference when it comes to buying a stock. This has a limit price. Now you can also do this for a stock, but this is specifically for stock options. The limit price is how much you are willing to pay for the contract. So in this case, it's currently worth $723, but people are bidding for it, meaning that they are only willing to pay $715 for it. But people are asking for $730 for it. So that's why the market is pricing it at $723. So once you pick your price, now sometimes Robinhood will say it's not filled, or it is filled, or it's pending, or it's placed. Sometimes you can wait. However, if you wait too long, depending on the stock, it may not fill. So you would go back into that same order that you were doing, and then you will see an option that says replace order. That will mean that either the price of the option went up or the price of the contract went up. So you may have to pay a little bit more or a little bit less. And that's when playing around comes into play. You want to finagle with it to see what price is best for you, that works for you. All right. So now getting into buying a put on Robinhood. So again, same exact thing. The lower you go, however, is the cheaper the options get. So the higher you go, the more expensive it is. Because, of course, we're betting against the price going down. I mean, there's, of course, a further strike price. And the same thing. Same exact page as the call. Put in the number of options. Put your limit price in. Tells you the price. Boom. Click and done. Submit. Simple. Very, very simple, ladies and gentlemen. The only time it gets complicated is when we're doing spreads, which we are going to be doing in our upcoming videos pretty soon. All right, and ladies and gentlemen, that's pretty much it. That is it. So again, the key things that you all need to remember, please, ladies and gentlemen, when it comes to trading: buy time when it comes to stock options. Research everything that you're looking into, especially the company itself. Find a decent strike price. Find a decent expiration date when it comes to a stock option. Build a long-term portfolio along with stock options. Make a balance. But also, most importantly, don't be scared. Do not be scared. Do not be mad. Do not be stressed. This should only be for not even quick money. This should be a side hustle. This is not quick money. Not quick money at all. If you're struggling, if you're scraping at the bottom of the barrel, you only got $40 to your name, throw 10 in. Give $10 a shot. Literally. Like, this is something that anybody can make money on. And this is the reason why we're doing these videos. Because I feel as though that there's too many people out there that are just taking advantage of individuals that are not educated or just don't have the necessary means to, not even the means, just the knowledge of, or even the time to understand all this. So that's another reason why we're doing this, is just to I guess, consolidate everything and try to make it as simple as humanly possible. But you also have to remember this: you cannot be scared. Scared money don't get money. Scared money does not get money. And I'm hoping that this also too maybe makes you guys take a look at yourselves and realize something that you may have missed, as it did me. You know, you may learn a lot from option trading, believe it or not. You may learn a lot about yourself through option trading. You may have a lot of hidden demons that you never knew that you had to clap real quick. But yeah, that's it, ladies and gentlemen. That's it for our first session. I hope you enjoyed. Hope you learned something. And if there's something that you missed, we can go ahead, go back and rewind. You can pause it. You can jot it down, write it down, do whatever it is that you need to do to learn. That's what this is here for. Feel free to ask any question whatsoever if you're in our chat, or make a comment down below. Send us an email. We have an email down below. And again, we are here. So thanks so much for watching. Oh, before we forget, this is what we're going to try to cover next session. Again, we mentioned the spreads earlier. There are a whole bunch of different spreads that we can learn from. These are protection plays that protect you against losses and also increase your gains too. For example, we got the ghetto spread, which was invented by the Cult 2019, by the way. That is a very special spread that I use on a daily basis. But yeah, there's a lot that we'd like to get into. There's a lot to learn, but it should be fun, ladies and gentlemen. But again, I hope you enjoy. Give us back any feedback, anything that we need to work on, anything that you would like to see. Let me know. Let us know. We appreciate you. Much love. Stay safe. Be blessed.